Good evening. Welcome to the July 12th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver Kennedy, and I'm so pleased that you decided to join me for this evening's broadcast. If you can bear with me for just one moment, I'll share my screen and I'll give you a quick bit of information about the center, about office hours, and then we'll jump right into the questions that have been submitted from our community. Welcome again to Office Hours. Let me tell you just a little bit about the Maryland Center for Collegiate Financial Wellness. We were founded in 2021 with the vision that all college and career school students in the state of Maryland have the chance to achieve all 6 of these pillars of collegiate financial wellness. That is being creditworthy, ready, resilient, empowered, successful, and thriving. I will spare you all of me reading all the text, but if this sounds like a cause that you're interested in or a vision you'd like to know more about supporting, please do visit us online at mccfw.org. Again, that's mccfw.org. Now, about Office Hours specifically. Office Hours is a free, semi-monthly virtual student loan clinic that provides borrowers with a trusted venue to help them navigate student loans and prepare for financial success beyond repayment. Before I get into the questions that came in this evening, I just have to share a quick disclaimer with you that Office Hours is presented for informational purposes only and should not be construed as financial or legal advice. We do strive to give you the most up-to-date and accurate information available when we're answering the questions that have come in from members of our community. However, there's only so much you can relay in a question, and there are many factors that go into making decisions related to your student loans, such as your household size, income, the level of debt you have, your repayment goals. There's just so much that we don't know when we receive these questions. So keep in mind that while we're providing answers to the questions and possible strategies and solutions around repaying debt, this advice is for informational purposes only. Before you make a decision, make sure you take into account your personal circumstances and your loans, as well as the information presented by reliable sources, such as the Maryland Center for Collegiate Financial Wellness. Now that I have that out of the way, I received a question, and that first question is, what happened to the June 28th episode of Office Hours? Well, long story short, we did record the episode of Office Hours. We actually went live on Facebook, and it turns out no audio came through. So we had a video file, but there was no audio there, so people couldn't hear the answers to the questions. So we decided to take that video down and just wait to see what was going on with the Supreme Court. And so on June 30th, when the Supreme Court finally made their ruling about broad cancellation, that decision kind of wiped out a lot of what we were discussing in the June 28th episode of Office Hours. So we decided not to post it. And tonight we're going to be speaking more about that Supreme Court decision. And we've made several updates to answers for the questions that were submitted ahead of the June 28th episode of Office Hours, because now some things have changed. So to the person who submitted this question, thank you so much for submitting the question, because that lets us know that people are watching and looking for Office Hours, which is exactly what we want. But it's kind of a blessing in disguise that that episode did not end up being posted, because by the time we would have gotten it up and live on YouTube with the annotation for all of the questions, a lot of the answers to those questions would have changed. So we'll get into some of those changes tonight. All right, so first question here. I had loans forgiven already. Does the Supreme Court decision mean I have to pay back the debt? This is a question that I heard a lot, especially on June 30th, the day that that decision was handed down. And the answer is the Supreme Court ruling was related to broad cancellation only. The ruling does not affect any previously discharged student loan debts, nor any relief that you might have forthcoming from another program. The Supreme Court decision was just about the Biden-Harris Student Debt Relief Plan, which was the plan that would have provided up to $20,000 per eligible borrower if that plan had been allowed to move forward. So if you had loans that were forgiven by way of, for instance, one of the people who reached out to me had debt that was forgiven by way of borrower defense to repayment. The Supreme Court's decision has nothing to do with that discharge debt. If you had debt that was forgiven by way of public service loan forgiveness, the same is true. The Supreme Court decision has no effect, no influence on public service loan forgiveness. So please don't think that because this one particular plan was struck down, that loan forgiveness or cancellation is not possible with some of the other options. All right, so let's move on to the next question. Does the SCOTUS ruling mean no more loan forgiveness? Well, similar question to the one that I just answered, but just to be very, very clear, the Supreme Court ruling on June the 30th was related to the Biden-Harris Student Debt Relief Plan. That plan was proposed in August of 2022, faced several legal challenges, and eventually on June 30th, that is, the Supreme Court ruled that the plan would not be able to move forward. It's been permanently blocked. But there are other options for relief that remain unaffected, such as public service loan forgiveness, the income-driven repayment adjustment, which sometimes you might hear referred to as the IDR Adjustment or the IDR waiver, as well as borrower defense to repayment. So the Supreme Court ruling was a decision that was about one particular relief program. The other relief programs are not affected or not included in that Supreme Court decision. So just to present this to you another way, when you look at the major relief programs, especially the ones that we've been talking about during office hours in recent months, you have the Biden-Harris Student Debt Relief Plan. That's a plan that would have relieved up to $20,000 per eligible borrower. You have the IDR Adjustment, through which borrowers can have up to the remaining balance of their federal student loan debt canceled. And then you have public service loan forgiveness, which is designed specifically for public servants. They can also have up to the entire remaining balance of their debt canceled through that program. So you'll notice that with the IDR Adjustment and public service loan forgiveness, both of those programs will feel no effect from the Supreme Court's ruling. The only program that has been affected is the Biden-Harris Student Debt Relief Plan. That, again, was going to provide up to $20,000 worth of cancellation per eligible borrower. That plan went as far as having an online application available, but none of the cancellation had been distributed by the time the plan was temporarily blocked because of lawsuits. And finally, the Supreme Court made its decision on June 30th of this year that the plan is permanently blocked. Also, the IDR Adjustment and public service loan forgiveness are ongoing. So please do not be discouraged. If you were thinking about pursuing cancellation through one of these other avenues, please do not be discouraged by the Supreme Court decision. Please move forward with your application. All right. So the next question is much more specific. It's about monthly payment, since repayment is going to resume for the vast majority of borrowers in October of this year. My servicer said that my next payment is due in October and it's $823 per month. I have a friend with six-figure student loan debt who pays $25 per month. How is that possible? So this is yet another one of those situations where if you're looking to make a decision, you really have to take into account your personal circumstance. That's your household characteristics as well as your student loans, because there are several repayment plans available and two main approaches. The two main approaches to repayment are the balance-driven route and the income-driven route. With the balance-driven plan, your payment is based strictly upon the amount that you owe. Any flexibility with the balance-driven plan has to do with the length of time you choose to take in repaying that debt. But usually the payments are fixed and your household situation has no bearing on calculating that payment. The other route is the income-driven route. With income-driven repayment plans, your monthly payment is based on your household characteristics, such as your adjusted gross income, your family size, and tax filing status. So when I look at the difference between these numbers, on one hand, you have $823 per month. On the other hand, you have $25 per month. My thought is that one of these plans is based on the balance, and the other plan is based on the income. In this example, I'm going to assume that the person is a single tax filer with no dependents and an adjusted gross income of $23,330. This particular situation with no dependents, being a single filer and having an adjusted gross income of $23,330, when taken into account through the income-driven repayment plans, there is a plan that's out there that results in a monthly payment of $25 per month. That means that if this borrower enrolls in the income-driven repayment plan, makes that $25 payment each month, then the loan will stay in good standing. With income-driven repayment plans, your payments are set for 1 year, and at the end of each year, you have to answer the same set of questions, and the calculation will be run again. Now, the alternative to an income-driven repayment plan is a balance-driven plan. And I want to make a special note for people who are preparing to enter repayment for the very first time. If you are just about to embark on repayment, you need to make sure that you choose a repayment plan for yourself. Because if you do not choose a repayment plan for yourself, then the standard 10-year plan will be selected for you. So one of the numbers that the person who sent this message included in the message was $130,000 for the amount of outstanding debt of the friend that they were speaking to. So if we look at this outstanding debt of $130,000, under the income-driven repayment plan, the payment is still $25 because it's based on income. It's not based on how much the person owes. But if you take a look at the standard 10-year plan, that's where you will see an enormous difference. The standard 10-year plan is a fixed payment every month for 10 years. And with a balance of $130,000, that standard 10-year payment is $1,378. Quick point before I move to the next slide. I know a lot of people will look at this and say, how is it possible that the same loan can have one payment option that's almost $1,400 per month and another payment option that's $25 a month? And I know that we're looking at two extremes here, but this is true. If you have a relatively low income, then you're going to have a lower monthly payment. And with the income-driven repayment plans, based on that person being a single filer, no dependents, and an adjusted gross income of $23,330, their first year payment is that's going to be required under that income-driven repayment plan is only $25. Now, another question that a lot of people ask after seeing an example like this is, well, if I only pay $25 per month, how am I ever going to make a dent in a $130,000 debt? That is a very valid question. And the answer is that if you continue to pay, if you start and continue to pay on this loan at $25 per month, you will never attack the principal. So even as you keep on sending in payments month by month, you will never see the principal balance go down if you continue to make a payment that's so low that it never covers the level of interest that's accruing. That whole concept of never attacking the principal with your payments is something that's called negative amortization. That means that the loan is accruing so much interest each month that the payments that you're sending in are not enough to keep up with that interest. And if you never cover the interest, then your payments will never be able to be directed toward the principal. And because of that, income-driven repayment plans have a built-in cancellation provision after the borrower has been in repayment for either 20 or 25 years, depending on the types of loans they have and the repayment plan that they're enrolled in. So to answer the question, yes, it's quite possible that your payment could be $823 per month, or it could be $25 per month, or something even lower, depending on your household situation. But it really comes down to the type of repayment plan you choose to pursue. Do you want to go the balance-driven route, where the payment is simply based on the amount of debt you owe? Or would you rather take the income-driven path, which makes a payment that is set based upon your household characteristics? All right. Just a few points about income-driven repayment plans before we move on to the next question. With monthly payments for income-driven repayment plans, they're based on your household characteristics. That includes your tax filing status, whether you're single, head of household, married filing separately, or married filing jointly. Also, your household size. How many people are in your household, and within the household, how many of those people are considered dependents? And then the third category is your adjusted gross income. What are your earnings? And you can find that figure on your personal income tax return. If you visit studentaid.gov and use the loan simulator, you will, if you go through the simulator, it'll ask you questions. What's your tax filing status, household size, adjusted gross income, as well as your state of residence. But if you are actually completing an application for the income-driven repayment plans, then you will be prompted to give permission for the Department of Education to receive information from your most recent tax transcript from the IRS so that they can directly get the answers to those questions about your tax filing status, household size, adjusted gross income, and state of residence. You don't have to do that. If you want to self-report your income, that's an option. But if you want your application to move along more quickly, then the IRS transfer option would definitely make a difference in that processing time. Also, with income-driven repayment plans, your payments require, or the payment plan, I should say, requires an annual recertification process. The process of recertification is simply answering the same questions that you were asked the year before. What's your tax filing status? What's your household size, adjusted gross income, and state of residence? You can also have that payment updated earlier in the event of a life change. One question that I get a lot is, well, what if I lose my job and I'm on an income-driven repayment plan? Well, the answer is you want to contact your servicer as soon as possible, because you're going to experience a decline in income unless you find another job very quickly. Your situation is going to change, and it's going to change in a way that provides you with less disposable income. So you contact your servicer, let them know that you are not currently working. They can rerun the formula, and when you do get another job, you can contact the servicer again, or you can wait until the next annual recertification date and let them know that your income has changed. But I just want people to really remember that with income-driven repayment plans, it's about your income. So it's the payment that's calculated is going to ebb and flow. It could be up or down based on what's happening with your household finances. So a couple of common things that can cause, well, that will cause your income-driven repayment plan for the payment amount to change. One is if you earn more. So if you take a higher paying job, and that leads to you having a higher level of adjusted gross income, in the next cycle of recertification, if that pay increase has been reflected, you can expect to see a higher monthly payment required if all else remains constant. The second most common question I get is, well, what happens if I have a child? Or for some people who are caring for parents or other relatives, the question is, well, what if I add another dependent? If you add another dependent, the assumption is that you're going to have less disposable income. So more dependents equals payment decreases. So your monthly payment would go down. That's if everything else was held constant. Just on a life note, we all know that a lot of these things do not happen in isolation. So you may add a dependent, but have a pay increase in the same period. Either way, all of those changes, if they're reflected in your tax return, that information will ultimately be reflected in your payment amount when you recertify. But the key thing to remember here again is this: balance-driven plans are based solely on how much you owe. Income-driven repayment plans are based on how much you earn and other household characteristics. So there's more flexibility there. And that's why you might see, one plan with a payment of $823 and another one with a payment required of $25 for the same loan. All right, speaking of IDR, that leads to our next question. The new IDR plan, when will that IDR repayment plan go into effect? So we definitely had some things change right after we recorded that June 28th edition of Office Hours. The new repayment plan is called SAVE, and SAVE is set to roll out during the summer of this year. There is a note out there from the Department of Education that says additional benefits will follow in 2024. So I just wanted to, before I get into the details of SAVE, I wanted to preface this with the fact that if you log on to studentaid.gov today and you are using the loan simulator to calculate what your payment will look like once repayment resumes, you will not see SAVE as an option on that menu. You'll see, pay as you earn, income-driven repayment, or income-based repayment, income contingent repayment. you will not see SAVE. So although the plan is coming, you're not going to see it online just yet. I wanted to share with you a few features of this plan, but since this plan is new, I didn't want to paraphrase anything. I wanted to give you all information straight from the Department of Education, because this is something that is coming out soon and it's very new. So there's a lot of, what can I say? People aren't well versed with this yet. So until the plan has been fully implemented and I've been able to see this plan in action from the borrower's perspective, you'll see me including more information like this, cut and paste straight from the Department of Education, so I can make sure that you are getting information directly from the source. And if at any time you want to know more about the SAVE plan, please do visit studentaid.gov. You will see at the top of the page that there's a note about the Supreme Court ruling, as well as the implementation of this new repayment plan, which is called SAVE. So 3 changes that this plan will make. The first one is to increase the income exemption from 150% to 225% of the poverty line. And a lot of people will read this and say, what does the poverty line have to do with income-driven repayment? Well, the formula for income-driven repayment takes a look at your household's adjustable income, gross income, versus the 150% of the poverty line. And the difference between those two is what helps calculate your disposable income. So with the old or the current repayment plans, like revised pay-as-you-earn and income-based repayment, the income exemption is 150% of the poverty line. This SAVE plan is going to increase that income exemption to 225% of the poverty line. That means that effectively the government is going to be looking at a smaller amount of your income as available to put toward your student loan payments each month. So by raising the poverty line, it's actually decreasing the amount that borrowers in this plan would be obligated to pay. There's an example listed there. I won't go through the specifics of that example, but I just wanted to explain how the poverty line factors into the calculation for income-based repayment plans. The second thing that this plan would do is to eliminate 100% of remaining interest for both subsidized and unsubsidized loans after a scheduled payment is made under the SAVE plan. So if you make your monthly payments as promised, your loan balance will not grow due to unpaid interest. This is a big deal. In the previous question where we were looking at that example of one payment plan at $823 per month and the other plan at $25 per month, that $25, of course, was based on an income-driven repayment plan. And that $25 was nowhere near enough to cover the amount of interest accruing on that debt every month. So a person under those older plans who's making that $25 payment per month, they would keep the loan in good standing because they're making their payments on time in full as they're obligated to. However, they would never see the principal balance decrease, and they would always see the overall debt owed increase, because every month that accrued interest would keep on accruing and it would build up, and the total balance of that debt would continue to swell. Under this SAVE plan, it says the plan eliminates 100% of remaining interest for both subsidized and unsubsidized loans after a scheduled payment is made under the SAVE plan. So in theory, if you make your $25 a month required payment, then the interest that accrues would not be charged to you. So that could result in a huge amount of savings for a lot of people. But again, this plan is not out there yet, and I really need to get more details before I can truly give you a full picture of what this looks like in real life for a borrower. The third thing, this is another big deal. The third change that I wanted to highlight tonight was the SAVE plan excludes spousal income for borrowers who are married and file separately. So taxes or tax filing and student loan payments can become very complicated for people who are married, because with the income-driven repayment plans, household income is a factor. Under some of the plans, a person can file married but separately and have their spousal income excluded. But other plans, it doesn't matter if you file your taxes separately, your spouse's income is going to be considered in that formula. And for that application to proceed, the spouse is required to co-sign the income-driven repayment plan application. From the borrower side, or at least sharing the experience of many clients that I've worked with, the term co-sign is something that scares a lot of spouses, and some people flat out refuse to co-sign, and some people as a result choose not to proceed with their application for an income-driven repayment plan. The word co-sign, generally speaking, means that you are signing your name as another responsible party for a debt. So if I had a student loan, or not student loans, if I took out a personal loan and I asked my husband to co-sign for me, we would both be responsible for that debt. If I couldn't pay it, he would be pursued, as responsible for paying that debt as well. But when it comes to student loans and submitting an application for an income-driven repayment plan, the word co-sign has a completely different meaning. When a spouse is asked to co-sign an IDR application, they're not signing on to take responsibility for the debt. They're signing the application to indicate that the information that their spouse has included in the application is true. So there's no responsibility for the debt involved. There's no shifting the debt from one person to another. It's just kind of like a verification that the information that the spouse with the loans has included in that application is true. But the word co-sign, it just turns a lot of people off because of what it really means when it comes to lending. So the SAVE plan is going to exclude spousal income for borrowers who are married and file separately. That means that the spouse will no longer be required to complete that co-signature process for the IDR application. All right, so I mentioned at the beginning of my explanation about the SAVE plan that the plan is supposed to roll out this summer and additional benefits will follow in 2024. I just wanted to provide you with a list of those benefits. You'll notice that if you read some of these benefits, there are distinctions made between undergraduate loans and graduate loans. And honestly, that's what I really need to know more about before I can speak on this plan with more confidence about what it looks like for borrowers once it's implemented. So the first point here that is set to go into effect in July 2024 is that payments on undergraduate loans will be cut in half. That means they'll be reduced from 10% to 5% of income above 225% of the poverty line. So payments will be cut in half for undergraduate loans. For borrowers who have undergraduate and graduate loans, they'll pay a weighted average of between 5% and 10% of their income based upon the original principal balances of their loan. That 10% rate is the lowest rate that's out there now with income-driven repayment plans. So in July 2024, we can expect that for undergraduate loans, that rate will be cut in half, down to 5%. And that for people who have undergraduate and graduate debt, the new rate will be a weighted average between 5 and 10. Let's see, I want to move down to the third point because consolidation is something that's very popular right now to benefit from both public service loan forgiveness and the income-driven repayment adjustment. So that third bullet there says, borrowers who consolidate will not lose progress toward forgiveness. They'll receive credit for a weighted average of payments that count toward forgiveness based upon the principal balance of the loans being consolidated. So that goes into effect, or is scheduled to go into effect in July of 2024. The period that we're in right now is the IDR adjustment. And under the IDR adjustment, when a person consolidates, they will also not lose progress toward forgiveness. In fact, when they're consolidating, the entire consolidation loan would actually be given credit for the number of payments attached to the loan in the portfolio that has the greatest amount of repayment history, at least that figure. So this was something special that came about when the limited PSLF waiver was implemented October 6th of 2021. It's been allowed to continue through the IDR adjustment period. And for people to get the greatest benefit from that IDR adjustment, they would need to consolidate or complete the application to consolidate by the end of this year, December 31st, 2023. Also, borrowers will automatically receive credit toward forgiveness for certain periods of deferment and forbearance. This is similar to what's happening with the IDR adjustment and also what happened during the limited PSLF waiver. Something completely new is the next bullet. Borrowers will be given the option to make additional catch-up payments to get credit for all other periods of deferment or forbearance. So we might see some deferments or some forbearances that would not have qualified under normal circumstances. They can be reversed. We'll see how that works starting July of next year. Lastly, borrowers who are 75 days late will be automatically enrolled in an income-driven repayment plan if they have agreed to allow the Department of Education to securely access their tax information. So lots of changes are coming through this new SAVE plan. The rollout is set to start this summer, but as you can see from this list here, there are many benefits that will go into effect in July of 2024. All right, let's move to an easier question. This question is, I have a loan with Navient. Can it get forgiven? Excuse me. So I needed to know more about this particular loan, so I had to ask some follow-up questions. But in general, to know if a loan can be canceled or forgiven, you really need to know what type of loan it is. And we're looking at federal student loans. Within federal student loans, there are two types. There are commercially held federal student loans and federally held federal student loans. Whether the loan can be forgiven depends on what type of federal student loan you have. So some people have commercially held loans. These were not issued recently. Commercially held loans are loans that are not held by the Department of Education. There are other companies like Navient that might be the loan holder, even though the loan is a federal student loan. If the loan is commercially held, there are additional steps that would have to be taken before the loan could be considered eligible for credit through the income-driven repayment adjustment or through public service loan forgiveness. So for commercially held loans, to answer the question, can a loan be forgiven? As it is, no, it cannot be forgiven. If you'd like for that loan to receive federal or to be considered for federal student loan benefits, you would need to consolidate it into the direct loan program, and that application is found online at studentaid.gov. Also, if you want that loan to be considered for public service loan forgiveness, you must consolidate it into the direct loan program. And to get the greatest benefit toward PSLF or the IDR adjustment, or both, you would want to complete that consolidation application online at studentaid.gov by December 31st of this year. As for federally held student loans, to know if your loan is federally held, if it was included in the payment pause that began in March of 2020, then you have a federally held loan. Federally held loans are eligible for the income-driven repayment adjustment without requiring consolidation. But if you are interested in public service loan forgiveness, you must consolidate that federally held loan into the direct loan program to get it on track for public service loan forgiveness. And if you are not sure what kind of loan you have, commercially held versus federally held, your servicer is a good place to go, although sometimes it's still kind of difficult to find out the actual loan type that you have. Whereas if you visit studentaid.gov, you can take a look at the dashboard. You can click view details, view the loan breakdown, and you can look at the name of each loan in that breakdown. If you see, if you do not see in the section where the servicer is listed, if you do not see Department of Ed listed, or if the loan is in default, if you do not see default management systems, excuse me, I know I've got this acronym, I can't get it right now, but I think it's default management collection system, something to that effect. If you see either of those there, then the loan is federally held. But if you see, another company like a bank or like Navient, then that means that the loan is commercially held. So if you're not sure, please go to studentaid.gov, look at that list of loans, look at the loan types, the full names of the loan types. If you see the word direct, it's a federally held loan. If you see Department of Ed in front of the servicer's name, it's a federally held loan. But on the other hand, if you see, a bank name or something other than the Department of Ed listed in that servicer name, then the loan would be commercially held, and you'd have to take some additional steps if you want to get that loan or those loans on track for cancellation by way of the IDR adjustment and or public service loan forgiveness. All right, so for this particular borrower, I wanted to give some more details. This borrower had one loan, and that loan was a FFELP consolidation loan that included undergraduate loans only. The FFELP consolidation loan was dispersed in 2001. And when we took a look at that loan record within the servicer's website, the estimated payoff date for the loan was 2038. So if the borrower were to leave this loan as a FFELP consolidation loan and keep making payments, on time in full as promised, then this loan would be paid off in 38, representing a total of 37 years in repayment. I just want to share that two things. This is a FFELP consolidation loan in 2001. So that means that there were older loans that went into this consolidation loan. Those loans might have had a bit of repayment history themselves. Second thing is that federal student loans typically have a repayment term as a maximum of 30 years. So this particular borrower situation exceeds that, obviously. If they stay on this track, then this loan will have taken 37 years to pay off, and this is undergraduate debt. So let's look at their options. If the person decides not to pursue the IDR adjustment, they are likely to spend at least 15 more years in repayment. With the IDR adjustment, I want to stress that we are projecting what would happen. If the person would like to be considered for the IDR adjustment, they would need to consolidate this FFELP loan into the direct loan program by completing the application online at studentaid.gov. Within that application, they would want to select an income-driven repayment plan. This would be just to make sure that future payments would still count toward income-driven repayment. Next, they would make payments using that income-driven repayment plan once payments resume in October. Then, by the timeline we originally saw with the IDR adjustment, payment counts were expected. At first, I think it was supposed to be sometime this year, but that was postponed to 2024. So in 2024, by then we should see a payment count. And based on the history that I saw with this loan, I project that this student loan will be canceled by way of the IDR adjustment once the IDR adjustment is fully implemented. Now, after I met with this borrower to get some more details, the Department of Education updated its website about the timeline for IDR cancellation. And I pulled this text is straight from the Department of Education pulled today. And the timeline for IDR cancellation depends on when you reach your forgiveness milestone. The milestones that they're referring to for income-driven repayment are either 20 years, the 20-year rule applies to undergraduate loans only, or 25 years. And the difference between the two can depend on whether you have undergraduate or graduate school loans or the type of repayment plan you're enrolled in. For instance, revised pay-as-you-earn has a 20-year term for undergraduate loans, but if there are undergraduate and graduate loans involved, then that repayment term jumps up to 25 years, whereas pay-as-you-earn is just 20 years for everything. So think about if you have an old loan like this, it's been around, let's say, since the early 2000s, think about when you would reach your repayment milestone. What's 20 years out? Or if you had graduate loans, 25 years out. If you reach your forgiveness milestone before August 1st of 2023, according to the Department of Education, they expect to discharge your loans before student loan payments restart. If you reach your forgiveness milestone on or after August 1st of 2003, you will likely have to start making payments after the payment pause ends. And remember, that payment pause is going to end at the end of August. Interest will begin accruing again in September. Payments will actually be required in October. But according to the department, they do not want you to worry. You will get a refund for any payments beyond the number you need for forgiveness. So if we look at this particular borrower, oops, I'm sorry, I got ahead of myself. If we go back and look at this particular borrower, this FFELP consolidation loan was dispersed in 2001. So we are 22 years out from the disbursement of this FFELP consolidation loan, which contained undergraduate loans only. So we have 22 years of history to be considered. This borrower did not go back to graduate school and did not experience default. So that entire 22 years is basically up for grabs. I suspect that with the number and length of forbearances involved, that this borrower will have their debt canceled. And according to this new timeline from the Department of Education, they should have this debt discharged before student loan payments resume in October. I will most certainly provide updates on this borrower's situation because the consolidation loan application was completed maybe a month ago. We'll see how it shakes out because what I really like to be able to do for questions like this is provide you with information about how it looks in theory or what is supposed to happen according to the Department of Education, and then what execution looks like. How does this look in real life for the borrower? Right now, I don't have that borrower experience to share, so I'm sharing information provided by the Department of Education about how this process is set to unfold. So stay tuned for updates in the coming months. All right, now it's time to move on to the next question. That is, what if I can't make payments? So I want to go back to the question of what is your loan type. Regardless of your loan type, though, if you're experiencing difficulty and you think it's going to cause you to miss a payment, you want to contact your servicer before you miss that payment so that you can explore your options and do your best to keep the loan in good standing, even if you're not making payments. You can also explore income-driven repayment plans because they could be more affordable than the balance-driven options that are out there. But let me go back to the loan type and why that matters. For commercially held loans, there was no payment pause. So I can see how a person right now in July could be experiencing difficulty with making payments. I suggest you explore consolidating that commercially held loan into the direct into the direct loan program, because you could gain access to additional repayment plans, possibly that new SAVE plan that's rolling out this summer, as well as gaining access to the IDR Adjustment. So you might be able to put that old loan on the path to cancellation. For federally held loans, no one should be required to make payments right now in July of 2023. Payments are set to resume in October 2023. That's why I had this question here. Well, you can't afford to make a payment. What's your loan type? Because with a federally held loan, you're not required to make a payment right now, or you shouldn't be required to make a payment right now. If it's commercially held, payment has never stopped. So either way, make sure you contact your servicer before you miss a payment. Or for those who have federally held loans that are looking forward to repayment resuming and are doubtful about whether they'll be able to make the payments, explore an income-driven repayment plan to see if there's an affordable option out there for you that's based on how much you earn instead of how much you owe. Also, I wanted to share a bit about something that's being referred to as an on-ramp from the Department of Education. For borrowers who still cannot make their payments, the U.S. Department of Education is creating a temporary on-ramp period over the next year that will help borrowers avoid the harshest consequences of missed, partial, or late payments. During that time, missed, partial, or late payments will not lead to negative credit reporting, default, or loans being sent to collection agencies. So the on-ramp is basically there to provide some temporary leeway for borrowers to get back into repayment. For people with federally held loans, we haven't been making payments for more than 3 years now. And I know that going that long without payments has allowed people to enjoy perhaps a level of freedom and disposable income that was not possible prior to the pause. But the pause is going to come to an end. And since the transition could be, difficult for some people, the Department of Education has this on-ramp, which will make sure that those who do have difficulty to the extent that they're not making payments as they should, at the very least, they will avoid the most negative consequences of student loan delinquency and default. All right, I had a follow-up question come in about the on-ramp. That is the on-ramp just another payment pause? So that new on-ramp, is it more of the same? I want to be very clear in saying no, the on-ramp is not a continuation of the payment pause. The payment pause has had a few big benefits. One is that payments were paused. People with federally held loans were not required to make payments. But also, two key differences. During the payment pause, interest did not accrue. During the on-ramp, interest will accrue. So this is a big difference from the payment pause. The second difference is, and this again is pulled straight from the Department of Education's website, missed payments will not count toward loan forgiveness under any of the income-driven repayment plans or public service loan forgiveness. Right now, we are still in the payment pause. So people are not required to make payments, but those months without payments can count toward both income-driven repayment as well as public service loan forgiveness, even though people aren't making payments at all. The on-ramp will not provide that. So if you miss a payment during the on-ramp period, you will not get credit toward the income-driven repayment plans. You will not get credit toward public service loan forgiveness. So if you're pursuing cancellation by way of IDR or PSLF, if you want to stay on the fastest path, then you want to make sure that you're making payments that are going to count. So the on-ramp, you might not want to take advantage of being able to miss payments because of that. You might want to explore the income-driven repayment options to make sure that you have an affordable payment that can keep you on track for cancellation by way of IDR or public service loan forgiveness. All right, next question is also related to income-driven repayment, and that question is, when will IDR recertification happen? Now, I need to pause here. I pulled this from the Department of Education on June 28th of 2023. I did not go back to check and see if it's been updated since then. So I will make sure that I have that during the next edition of office hours. But according to the Department of Education on June the 28th, you will not be required to recertify before payments restart. And the earliest you could be required to recertify is 6 months after the payment pause ends. If you take a look at your account's aid summary, you might see a recertification date that's earlier than the end of the payment pause, and the Department of Education is working steadily to get those updated. As for the timing of recertification, here's what I'd like to share with you, straight from the Department of Ed again. If your recertification date falls between now and 6 months after the pause ends, it will be pushed out for 1 year. So as an example, if your account says your recertification date is December 1st of 2022, that's within 6 months of the end of the payment pause. And since you fell within that 6-month period, the date of your recertification will be pushed out for another year. So instead of December 1st, 2022, your recertification date will be pushed out to December 1st of 2023. Now, the recertification date is important because with income-driven repayment plans, your payment is based on your household characteristics and earnings. So every year you're required to recertify by providing answers to what's your adjusted gross income, your tax filing status, and the number of people in your household. Every time you provide those answers, they'll run the formula again and your payment will change according to that information. So because of the payment pause, those recertification dates have been steadily pushed. You might see a date on your account now that is not accurate, but the Department of Education is working on that. And you can expect, again, that if your recertification date falls between now and 6 months after the end of the payment pause, you will get an extra year to recertify. So recertification will happen, but it's definitely been pushed out. All right, we've got another question. It says, I'm in the military and I completed the application for student loan forgiveness last summer. So many colleagues have had their loans forgiven. Why not me? Well, upon asking some more questions about this particular borrower situation, the application that the borrower was referring to was the application for broad relief through the Biden-Harris Student Debt Relief Plan. That's the plan that would have offered up to $20,000 of cancellation per borrower. This particular borrower owed about $18,000, so they would have seen their entire debt eliminated had the plan been allowed to proceed. I suspect that what happened with that borrower is that he has colleagues who applied for public service loan forgiveness. I say that because no one was able to receive cancellation from the Biden-Harris Student Debt Relief Plan because it was temporarily blocked by lawsuits before it could be implemented, and as of June 30th, it has been permanently blocked. Public service loan forgiveness has been moving forward. There are also there's also been a lot of cancellation process through borrower defense to repayment. So there could be some colleagues that had loans forgiven that way. There's also a possibility that there could have been people who had debts discharged by way of total and permanent disability. So there are other reasons that colleagues may have had their debts canceled. I do believe, though, that the majority of that forgiveness has come from people who filed applications for public service loan forgiveness after the implementation of the limited waiver. So as for the applications, people want to know what happened to my application. Why have I not received any updates or forgiveness? Well, for the Biden-Harris Student Debt Relief Plan, you should have received an update to let you know that that plan has been permanently blocked, so no cancellation will be processed. As for the IDR Adjustment and Public Service Loan Forgiveness, those programs are ongoing and the Supreme Court decision had no bearing on them. If you're thinking about applying for cancellation by way of income-driven repayment, there is no application. If you have federally held loans, which includes direct loans, you will automatically be considered regardless of the repayment plan that you're currently enrolled in. However, if you do have commercially held federal student loans and you want those loans to be considered for the IDR adjustment, you need to consolidate them and complete the application to consolidate by December 31st of 2024. As for when you'll hear something, for many of us, it'll be 2024. For those who have reached that forgiveness milestone before August 1st, you'll likely hear something earlier. As for public service loan forgiveness, that there is an application. It's online at studentaid.gov/PSLF. After you submit the application, it may take a few months for you to receive some results. For the past 2 years, it's been about a 3 to 4 month wait time to have an application completely processed. Things appear to be speeding up a bit now that the Department of Education has made it so that the entire application process can be completed electronically. So as I keep working with borrowers, I will let you know if that time frame of 3 to 4 months truly decreases. All right, we got another question. This one looks interesting. It says, I finished undergrad in the 1980s and finished graduate degrees in 2000 and 2010. All my loans are direct consolidation loans. Do I need to consolidate again for IDR and or PSLF? So basically, you have a person with multiple degrees and multiple consolidation loans who wants to know, should they consolidate again? So I just want to show you an example of what consolidation looks like during the income-driven repayment adjustment. So when a person has loans with differing amounts of repayment history, prior to the waiver and the IDR adjustment, consolidation would reset their repayment clock. So if someone had 200 months of repayment history, that new consolidation loan would start with a new repayment term. Their first payment would count as payment number 1. The history would not count toward income-driven repayment or public service loan forgiveness. During the income-driven repayment adjustment, the consolidation loan will have a repayment clock that temporarily resets to 0. So right after that consolidation loan is dispersed, they will see a payment count that looks very low, because that first payment count only considers the length of history attached to the newly consolidated loan. Then another count, and I'm speaking about this from experience dealing with people who have applied for public service loan forgiveness after consolidating. So the repayment clock temporarily resets to 0. Low payment count is received, and usually within probably 2 to 5 weeks, another payment count that's more accurate is sent to the borrower. So in this case, we have someone with 3 different sets of loans from 3 degrees, and we're estimating the amount of history the borrower has with each of those loans. The oldest loan has 288 months of history. The middle loan has 200 months of history, and the oldest loan has 156 months of history. And I know you're thinking, this person went to school in the 80s. Why is this count so low? You know, that's obviously more than 30 years ago. Well, the IDR adjustment only goes back to July of 1994. So we can only look at the history after July of 1994. And we also have to subtract out the periods where this borrower was in school pursuing those additional degrees, because they were going in more than half-time credits. So their older loans were placed into an in-school deferment. And in-school deferment periods do not count for credits toward the IDR adjustment or public service loan forgiveness. So we have 3 sets of loans ranging from 156 to 200 to 288 months of estimated credit toward repayment. So if this person consolidates, the new consolidation loan would end up having at least 288 months of credit toward income-driven repayment. And that has to do with the treatment of consolidation under the IDR adjustment. If this person worked in public service, then they could have all of the time. That 288 months would be counted toward public service loan forgiveness. Actually, backtrack on that. All of that would be up for grabs after October 1st of 2007, because the IDR adjustment goes back to July of 1994, but public service loan forgiveness only looks at what happened after October 1st of 2007. So if this person has 288 months of history overall, only the history within that 288 months that took place after October 1st of 2007 would be up for grabs with PSLF. So if they completed their application for public service loan forgiveness and they've worked for a qualifying employer ever since October 1st of 2007, then this person could have their debt forgiven by way of PSLF as soon as those applications are evaluated. So for this person, consolidation would likely help them, because it would get all of their loans onto the same repayment clock, and their most recent sets of loans would benefit from the longer history of those older undergraduate loans. For the IDR payment counts, we're expecting to see the payment counts come out in 2024. And for people who've already reached that forgiveness milestone before August 1st, we expect, according to the Department of Education, that they should see something a bit earlier. So we'll see how this pans out. Alrighty, lastly, repayment is coming. So I just want to share a few things to help you get ready. For federal student loans, the best place to go is studentaid.gov, because there you can view your loans, you can view your servicers, you can also view the repayment plan that you're currently enrolled in. And you want to make sure that that repayment plan is affordable. There are several options to explore. If you want to see what those options look like, I encourage you to go online to studentaid.gov, log in, and use the loan simulator to take a look at those repayment plans that are available. You also want to make sure that you have up-to-date contact information within studentaid.gov, and that your servicers have up-to-date contact information for you. Also, for people who have commercially held loans, those loans were not included in the payment pause. So you don't have to get ready for repayment with them because you've been paying them all this time. However, if you have commercially held loans and federally held loans, and the federally held loans were included in the payment pause, you've got to get ready to now be responsible for both the payment on the commercially held loans and the payment that will be required starting in October on the federally held student loans. So you might want to consider consolidating all of those loans, the commercially held ones and the federally held loans together, so that you can benefit from the IDR adjustment. All right, before we close things out, I just want to share with you some options for accountability. If you have any complaints that you would like to submit regarding your loan servicer, you can visit the Consumer Financial Protection Bureau online at consumerfinance.gov. You can also visit the U.S. Department of Education Ombudsman. For both of them, though, I would strongly suggest that you try to resolve the problem with your servicer first. If you feel as though you're not getting anywhere, then that's when you escalate things to these external entities. If you're a Maryland resident, Maryland has a student loan ombudsman, and you can file a complaint with the ombudsman if that complaint is related to issues like failure by the servicer to communicate with you as a borrower, errors when it comes to crediting your principal and interest payments, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidation or modification errors, and or inappropriate collection activity or tactics. You can file a complaint by visiting the Maryland Student Loan Ombudsman's website online through the Department of Labor, and you can also take a look at the Maryland Student Loan Borrowers Bill of Rights to learn about the protections to which Maryland borrowers are entitled and the obligations of student loan servicers. All righty, thank you so much for joining me for this edition of Office Hours. We are scheduled to return on Wednesday, July the 26th at 7 p.m. Eastern Time. If you have any questions that come up in the meantime, please do feel free to reach out to the center online at mccfw.org/contact. You can submit your questions, and we'll probably select your question to be included in the next edition of Office Hours. As always, you can connect with us on social media. We are at the MCCFW on Facebook, Instagram, Twitter, and YouTube. Until it's time for our next edition, be well. Take care.